Welcome back to the deep dive. It feels like every day there's another news story about crazy markets, inflation, and all that. We're going to try to make sense of it all today.
Yeah, it's definitely a lot to keep up with.
Exactly. We're deep diving into A Compass to Navigate Stormy Waters. This report everyone's been buzzing about
Okay.
and weaving in some recent news to help you understand, where the global economy might be headed
Yeah,
and what it means for you as an investor, ready to untangle this whole economic puzzle.
absolutely. Let's get into it.
Okay, so this report starts with a pretty intense image. It talks about a world in flux, like navigating stormy waters.
Right.
They even mention those recent hurricanes, Helene and Milton.
Oh yeah, right here in the U.S.
Exactly.
And what's fascinating here is what the report's saying. They say that natural disasters, just like these hurricanes, they're inherently inflationary.
Okay, interesting. How so?
Well, think about it. You've got disruptions to all the supply chains, surges in demand for certain goods and services, and then you've got massive government spending on all the relief efforts.
Right.
All those things,
Yeah.
they push prices upward.
It's like this whole chain reaction.
It is. It is.
And speaking of chain reactions, did you see that Newsweek article about the flooded EVs?
Oh, yeah, I saw that.
Apparently they can, catch fire?
Yeah, they pose a serious fire risk,
Wow.
which is another curveball with all these hurricanes.
Right.
It could actually lead to more people wanting gas-powered cars again,
Really?
which would, of course, impact new car prices.
So, wait. The whole world's pushing for electric vehicles, but we might actually see this, short-term spike in demand for the, how do they put it, the gas guzzlers.
Yeah, exactly. It's kind of a step back.
It's wild, and it all ties back into this whole inflation thing.
It does, yeah. The report even compares the current economic environment to the 1970s,
Oh, wow.
which was, as you know, notorious for high inflation.
Right, yeah.
We're seeing similar things today. Rising energy costs, supply chain issues, and of course that increased government spending we talked about.
Makes sense.
They even have this chart comparing CPI changes, and the similarities are really striking.
Oh, wow. Okay, so we've got this backdrop of inflation and just general uncertainty, but then the report throws this really interesting idea out there. A 7-year economic cycle.
Yeah, yeah.
Are we really connecting ancient traditions to modern market cycles here?
I know it sounds a little out there, right? But they're referencing the Hebrew tradition of Shemitah,
Yeah.
which is
Oh,
basically debt forgiveness and letting the land rest every 7 years.
right.
And they argue that this cycle has actually appeared in the stock market before, like historically,
Hmm.
with, noticeable downturns often happening in this time frame.
I'm a little skeptical, but I'm listening. What's their evidence?
Well, they look at historical data and
Hmm.
all sorts of factors that could be influencing this cycle.
Mhm.
For example, there's the Kondratiev wave, which is this long economic cycle driven by technological innovation.
Right.
Then there's the juggler cycle. It's a fixed investment cycle, usually lasts 7 to 11 years.
Okay.
They argue that these cycles, along with things like commodity price shocks and interest rate changes,
Yeah.
all feed into this 7-year pattern.
So not just about mystical beliefs or something. There could be some real economic forces at play here.
Exactly. Though the question is this cycle really a reliable indicator, or is it just kind of an interesting coincidence?
Right, right.
Something to think about as we go deeper.
Okay, so we've got this potential 7-year cycle, maybe influenced by ancient traditions and modern economics. But then the report throws another curveball. They think we need to rethink the whole business cycle.
Yeah, yeah. They say we should get away from traditional government data
Okay.
because it can be unreliable, even manipulated, and we should focus on market data instead.
Interesting.
Specifically, they highlight energy efficiency and currency quality as key indicators.
Instead of relying on government reports and statistics, we should be looking at how a country uses energy.
That's the idea.
That's a new one.
Well, a modern economy is basically energy transformed into all the stuff we use and consume, right?
Yeah.
So how efficiently a country makes that conversion, that's key.
So a more energy efficient economy is basically a more productive economy.
Exactly. The report uses the S&P 500 to oil price ratio to measure this.
Okay.
They say that comparing that ratio to its 7-year moving average can tell us if an economy is booming or busting, regardless of what the government data says.
So instead of just looking at GDP growth or unemployment, we're looking at how efficiently a country is using its energy to create value.
You got it.
That's fascinating.
And it's not just about energy efficiency. The report also emphasizes currency quality. A strong currency is a good store of value, but a weak currency, that erodes purchasing power over time.
They use gold as the standard,
Yeah.
right?
I guess they compare the price of gold to government bond
Yeah.
returns. If gold is outperforming bonds, it suggests that the currency is being debased, leading to inflation.
So it's all about understanding if your money is holding its value or slowly, losing its purchasing power because of inflation.
You got it. And now is where the report starts analyzing specific economies, like the US, China, Japan, and the Eurozone, using these new concepts of energy efficiency and currency quality.
Okay, so now we're going to get into the nitty-gritty of how these major economies are actually performing. This is where it gets really relevant for investors. What does all of this mean for your portfolio? We'll get into that right after this.
So are you ready to see how all this plays out in the real world, like how these economic forces are actually impacting the big players globally, and of course, what it all means for your investments?
Let's do it. Let's start with the U.S. What's the report say about investing here?
Well, they identify the U.S. as being in an inflationary boom.
Okay.
Basically, it's energy efficient, which is good,
All right.
but it's also experiencing currency debasement. And historically, that kind of setup, it favors stocks.
So stocks are looking good. That's a relief.
Well, not so fast. Remember that S&P 500 to gold ratio we talked about?
Yeah.
Well, it just dipped below its 7-year moving average.
Oh.
And historically, that's not a good sign. Every time that's happened, it's been followed by, economic turmoil and negative returns for the stock market.
So even though the U.S. is technically in this inflationary boom, this gold ratio is like flashing a warning sign.
Exactly. Could be some trouble brewing under the surface.
Okay, that's a little unsettling. What about specific advice for people investing in the U.S.? The report has that whole how to trade it section.
Right, it does. And it gets pretty specific. They actually say that simply owning the S&P 500, like a broad index fund, might not be the best strategy right now.
Interesting. So what do they suggest instead?
Overweighting sectors that are linked to energy production.
So instead of buying a general index fund, we should be looking at energy stocks.
That's what they say. Companies involved in oil and gas exploration and production, oil services, even alternative energy sources like uranium and copper mining.
Yeah, those are all like benefiting from the electrification trend anyway, right?
Exactly. If we're heading towards an energy crunch, those are the companies that will likely benefit.
Makes sense. What about the rest of the portfolio? Bonds, cash, all that.
This is where it gets really interesting. They argue that long-dated U.S. treasuries, those long-term government bonds,
Yeah.
they've become, and I quote, uninvestable.
Wow.
Returns are low, interest rate risk is going up. Instead, they recommend focusing on short-dated, investment-grade corporate bonds for cash management. Basically, high-quality corporate debt.
So ditch the long-term government bonds, stick to the high-quality corporate debt. Interesting how this analysis is leading to some unconventional investment recommendations. What about the other big economies out there? What about China?
China is a different story. They call it an inflationary bust,
Yeah.
meaning it's both energy inefficient and experiencing currency debasement. Not a good combo.
So not a great place to be economically. What does that mean for investors?
Well, the Chinese government has been, doing stimulus and stuff to try and boost the economy, trying to shift it back into an inflationary boom.
Right.
But until that actually works, the report says the best asset for Chinese investors to hold is actually physical gold.
Really? So the U.S. is leaning towards energy stocks and China is more of a hold gold situation.
Exactly. They see gold as a hedge against all the uncertainty and currency risks in China.
Okay, I can see that. What about Japan and the Eurozone? What's happening there?
The report lumps those two together. They're both in an inflationary boom phase right now, kind of like the U.S.,
Okay.
but they just came out of inflationary bust periods.
So they're kind of walking a tightrope, one misstep, and they could fall back into that energy inefficient, currency devaluing scenario.
Right. For investors there, they suggest a similar strategy to the U.S. A diverse portfolio of stocks, but pay attention to any signs of a shift back to an inflationary bust. They also emphasize physical gold as a hedge, especially with the potential for energy supply problems in both places.
It really seems like across the board, physical gold is becoming a much bigger part of investment strategies these days. It's not just a niche thing anymore.
Yeah, that's one of the big takeaways from this report. It's not just about chasing the highest returns anymore. It's about protecting your wealth, guarding against all the risks and uncertainty. And gold has a long history of doing just that. But it's not just about financial security. The report also suggests gold could be a buffer against
It really feels like everywhere you look these days, nobody trusts institutions anymore, especially in the West.
Yeah, I see that.
It's like governments are printing money like crazy. Central banks are just making stuff up as they go. And
Yeah.
well, we don't even have to get into that. So what
Right.
do we do?
It's a big concern, for sure. And the report actually talks about it. They say this loss of trust is pushing investors towards assets that are, outside the traditional system, things that governments can't easily manipulate or, just take away.
And that's where gold comes in, right?
Exactly. It's like the ultimate safe haven.
Yeah.
It's been a reliable store of value
Yeah.
for centuries.
I mean, it's tangible. You can hold it. It's not like some number on a screen.
Right. And its value doesn't depend on any government or bank or anything like that.
So in a world that feels increasingly like unpredictable and kind of out of control,
Yeah.
gold is like the ultimate insurance policy.
It is, yeah. The report even suggests that investors should actually consider holding more gold than usual, especially if they're worried about all this declining trust and, rising geopolitical risks.
So we're not just talking about a small percentage of your portfolio anymore. We're talking about a significant chunk dedicated to physical gold.
Yeah. It's a bold statement for sure. But I think it just reflects how much uncertainty and potential risk people are feeling right now.
Right.
The point is, gold isn't just about returns. It's about preserving your capital.
Yeah.
In a world where, traditional safe havens like government bonds, they might not be so safe anymore.
So as we wrap up our deep dive into a compass to navigate stormy waters, what's the key takeaway for our listeners? People who are just trying to figure out this crazy economic landscape and, where to put their money.
Well, I think the biggest thing is don't be afraid to, question conventional wisdom.
Yeah.
That old way of thinking, relying on government data, sticking to that traditional 60-40 portfolio.
Yeah, the old playbook.
Right. It might not work anymore.
We got to think differently. Like you said, look at the world through these new lenses, energy efficiency, currency quality.
Absolutely. And be ready to adapt your investment strategies. That could mean, holding more physical gold, putting more of your money into energy-related sectors, and being really picky with your bonds.
It's about being proactive, not reactive. Understanding the forces at play and getting yourself ready to, weather the storm.
Couldn't have said it better myself. But, there's no one right answer for everyone. Everyone's situation is different.
Of course.
So do your own research, talk to a financial advisor if you need to,
Yeah.
and figure out a strategy that works for you. One that aligns with your risk tolerance and your goals.
Great advice. This deep dive has given us so much to think about. And, before we go, I wanted to mention one more thing from the report.
Oh, yeah.
They suggest that gold isn't just about financial security.
Okay.
It could also protect against what they call collective stupidity and government overreach.
Interesting.
It's a pretty thought-provoking idea for sure. Something to think about as you navigate your own financial journey.
Thanks for joining us on the Deep Dive. We'll be back next time to explore more complex topics and bring you the most valuable insights.